This video is for you if you are a business operator and want to know what's happening in your business in the next 12 months, in the next 24 months, in the next 36 months. In fact, this forecast I'm showing you is really cool because it meshes a pro forma profit and loss statement over 24 months. You can easily extend it to 36 months. And it also shows you what your cash balance will be. In this example, the business has already been operating. It's an inventory-based business. We are looking for a small capital injection, and I'm going to show you how all of that looks in terms of how I create the financial projection and what you also want to be thinking about when you are creating financial projections. So remember, this is an inventory based. I always like to start with revenue. Revenue is really important to get clear on of how you are going to calculate revenue. And every business is a little bit different. So in this example, it is an e-commerce business. There's two different revenue streams. And in those revenue streams, what we looked at and what we decided was we're going to go for orders per day and the average order. We chose this because orders per day is something easy that we can track. And the average order is great because customers will pick different orders and we can look at an average of the order value for us to be able to really get into what we believe is possible. We know the strategy that the marketing team and the sales team is going and the web team really is going to be using when it comes to orders per day and average order, right? It relates to our marketing activities, which I will be able to show you. We feel confident that this is possible to do. I have revenue stream 1, revenue stream 2. And then this customer, there's discounts that are related to the products. They use it as part of their marketing. We account for that to get net revenue, which is in line 25. Then we have our cost of goods sold for each of the different revenue streams. In this example, the cost of goods sold is calculated over here. So 45%, and it's taking it from total revenue stream 1. And this is total revenue stream 2. So we get an idea about our cost of goods sold. So then it gets us to our gross profit, which is taking our net revenue minus our cost of goods sold. And this is allowing us to really get an idea about overall the profitability of this business model. So the key components to get more profitable are how do we do less discounts? Is that percentage? Can we lower that percentage? Can we decrease the cost of goods sold percentage, which then would increase our profit margins? That is important to look at. Ultimately, the key drivers for revenue are orders per day and the average order, which gets us a daily gross revenue amount. Our next one, I will look at an operating budget, and that operating budget is going to be here. I like to think about it in different categories. I like to think about it in our growth expenses, which relates to our marketing, right? So you can see that in line 24 to 31. And then I like to think about it in facility costs. You have to have a storage unit if you're selling inventory. Well, no, you don't have to, but typically you would. You have utilities, maybe you have some repairs and maintenance, so facility costs, labor costs as well, including any part-time labor. If the owner is also considered an employee, put that there, and then compensation. And then also what I like to look at is our general and administrative, right? So you often hear this in an accounting term as like SG&A. And so this would be your general liability if you're paying that on a monthly basis, bank fees, cell phones, maybe you have miscellaneous supplies and expenses, subscriptions, so QuickBooks, Google, any web subscriptions, anything that's general and administrative in nature. If you are driving a lot for any type of thing for your business, or you've got people in your business driving, that would be included here. And then professional services. If you've got legal services, accounting services, that would be considered any type of professional services. And how I like to map this is that I map it so that when you're reviewing this, you can really assess in each of these categories where you're spending the money and if it's aligned with your strategy, as well as if it is really supporting you with your long-term goals. This also maps in certain aspects to how you would file taxes so that your tax filing at the end of the day is going to be easier. So then I get my total, I have total general and admin, total labor cost, total facility, total sales and marketing. Then I have an annual thing to look at, at what time do I have annual renewals? And then I've got a total operating expense, and that looks at all of those categories. So it doesn't include our cost of goods sold here. This is just our operating expenses. And then we look at next is then our total cash flow from operations, which includes our inventory related purchases, as well as our total cash flow from operations. So it really does include everything. So that gets us an idea of what our total cash flow is. I include this as both a profit and loss as well as a cash flow. This is one idea about cash flow projections that can support you in financial projections. Very different than if you're truly raising capital, because this would be called net income, earnings before interest, tax, and depreciation. Even though this is actually looking the same, the categories are a bit different because we are talking about cash flow forecasting. So this is from cash flow from general operations, but you might have to make other payments and you might actually have other incoming sources. In this example, we have an SBA loan that we're accounting for. I also like to include, when you're thinking about your cash flow, is you have projected taxes. You know, based off of this, what your estimated net income is. And from there, we should be projecting out and then paying taxes. So I also have an estimated taxes over here. From that, I have a total cash outflow and then cash at the end of the period. So this then looks at your beginning cash balance, total cash on hand, plus your total cash inflows, minus your total cash flow from operations, minus your total other cash outflows. And that gets you a period of what your balance is. And that actually carries forward into the next month. So here we have M1 to M12 in this model. You can change it. Let's say that it's October 2024, and then I would just carry this forward here. Now, what's important here is that for all of this to work, you want to have a clear understanding of your operations. Without a clear understanding of your operations, these numbers really don't matter. So that's why it's really important as you are going through a cash flow forecasting is to assess the business model at that moment. When you can assess the business model, you understand the key components of cost of goods sold. What are the key components of actually generating revenue and calculating revenue? What are these operational costs that help reach those goals? When you have past data from your actual accounting records, you're going to have much clearer cash flow projections in your business. So this is the methodology I use for service-based and e-commerce businesses. The main difference here is that with any inventory-based business and e-commerce business, there is an extra component of truly understanding all the costs associated with inventory and then understanding how are those costs really outlined month over month so that you can forecast it well. This is a cash flow forecast for an e-commerce business.